Silver can be volatile on its own. Now imagine doubling that volatility. Today, we're breaking down the ProShares Ultra Silver ETF, ticker AGQ, and explaining exactly what it is, how it works, and why this is not a buy-and-hold investment. This is the ETF Investor, and this ETF demands extra attention. AGQ is a 2x leveraged ETF designed to deliver twice the daily performance of an index tied to silver futures contracts. The key word here is daily. AGQ is not trying to double silver's long-term returns. It's built to amplify one-day moves in silver prices. The fund tracks silver using COMEX silver futures contracts, not physical silver. Unlike many leveraged ETFs that rely heavily on swaps, AGQ primarily invests in futures and forward contracts. Because of this structure, AGQ is classified as a commodities pool, which means investors receive a K-1 tax form instead of a standard 1099. The futures contracts follow a fixed roll schedule. The index rolls into contracts 2 months from maturity in February, April, and June, and 3 months from maturity in August and November. Each contract is tracked until shortly before expiration, at which point the fund rolls into the next scheduled contract. This rolling process introduces what's known as roll yield, which can either help or hurt returns, depending on whether the futures curve is in contango or backwardation. Over short periods, this matters less. Over longer periods, it can significantly erode performance. And that brings us to the most important point. AGQ is not a buy-and-hold ETF. Because it resets daily, AGQ is subject to compounding effects. In volatile markets, those effects can cause returns to drift away from the expected 2x outcome over time. Even if silver ends a week flat, AGQ can still lose money. That's why AGQ is best viewed as a short-term trading tool, not an investment. It's designed for traders who have a strong, short-term conviction on silver's direction and are actively managing risk. Holding costs and expense ratios matter less here because the fund is intended to be held for days, not months. The real risk comes from volatility, leverage, and timing. AGQ can be powerful during strong, trending silver rallies, but it can be equally destructive if silver chops sideways or moves against you. Losses are magnified just as quickly as gains. The bottom line is simple. AGQ is a tactical instrument, not a portfolio position. If you're looking for long-term silver exposure, unleveraged products like SLV are far more appropriate. AGQ is for experienced investors who understand leverage, futures, and daily reset mechanics. If you found this breakdown helpful, subscribe to the ETF Investor and let me know in the comments whether you prefer leveraged ETFs for trading or avoid them altogether.